Imagine this. Your partner passes away. Your income drops significantly, but your taxes increase. Welcome to one of retirement's most painful surprises, the widow's tax penalty. It's one of the most overlooked risks in retirement planning, and yet it affects millions of households. When couples plan for retirement, they often assume a long, shared life. But real life has its own script. I've seen it firsthand. My own mom passed away the very year my dad retired. That wasn't in the plan. So, in this video, I'm walking you through exactly how the widow's penalty works, how it sneaks up, and most importantly, how to defend yourself against it with smart planning. Here's the basic setup. When a spouse dies, the survivor usually loses one Social Security check. Yet, at the same time, they often inherit the deceased spouse's IRA. So now, that surviving spouse is still on the hook for required minimum distributions, RMDs, but those distributions are taxed using the less generous single-filer tax brackets. To make matters worse, Medicare premiums are also income-based and use the same single versus joint thresholds. This combo can lead to a painful rise in taxes and healthcare costs, even as income shrinks. That's the widow's penalty in a nutshell. Let's bring it to life with an example. Meet Joe and Kathy, both age 75. Their combined IRA is worth $2 million. Joe receives $3,000 per month from Social Security, and Kathy receives $2,000. No fancy investments, just retirement savings, monthly Social Security, and $9,000 in total. Monthly net income. When they turn 75, RMDs begin, giving them a surplus of income. On paper, it's a solid plan. But now, imagine Joe dies at 75. Kathy's Social Security drops from $60,000 to $36,000 per year. She'll now receive Joe's higher benefit, and her own disappears. But RMDs remain the same, $81,300 in 2025. In a side-by-side comparison, the numbers get stark. Married, they had $130,000 to $300 in total income. As a widow, Kathy has $111,900. Their joint standard deduction was $33,200, but Kathy's new single deduction drops to $17,000. After deductions, their taxable income was $99,100 together. Kathy alone, still $94,100. That's barely a change. And here's the kicker: federal taxes. As a couple, they owed $11,630. As a widow, Kathy owes $15,192. Her effective tax rate jumps from 11.7% to 16.6%. That's a 35% increase. Her after-tax income drops by 20%. And then comes the Medicare surprise. Kathy is pushed into IRMAA Tier 1, meaning higher premiums for her health care even though she now has less income. All of this triggered by one life event. That's the widow's penalty in action. And it's brutal. So what can you do about it? Planning ahead is the key. First, build tax diversity into your retirement income. If all your retirement savings are in pre-tax accounts like traditional IRAs or 401ks, every dollar your surviving spouse withdraws will be taxed. When they file as a single taxpayer, they hit higher brackets faster. Instead, create 3 buckets. 1. Tax-deferred accounts. 2. Roth accounts for tax-free withdrawals. And 3. Taxable brokerage accounts. That third one? It's a game changer for flexibility. With all 3, you can better manage your taxable income each year, and your surviving spouse will thank you later. Second, take advantage of the golden window between retirement and RMD age. If you're retired in your 60s and not yet collecting Social Security, you're in an ideal position to execute Roth conversions. Move money from tax-deferred to Roth while you're still in a lower joint tax bracket. This shrinks future RMDs and helps shield the survivor from a later tax spike. This isn't just smart, it's a strategic win. Third, be thoughtful about your Social Security claiming strategy. I don't buy into the cookie-cutter advice to always delay. It depends. But when it comes to protecting your spouse, delaying your benefit could be your smartest move. The higher your benefit, the higher the survivor benefit. Even if delaying doesn't serve you directly, it might create lasting financial security for your loved one. Fourth, don't overlook qualified charitable distributions, QCDs. If charitable giving is part of your life, you can donate directly from your IRA once you're 70-1-2. The amount satisfies your RMD but doesn't count as taxable income. I've met so many generous folks giving regularly to churches and charities, but they're missing this tax-smart move. Don't be one of them. At the end of the day, all of these strategies point to one mission: proactive planning. It's not just about taxes. It's about peace of mind. It's about protecting your spouse. It's about honoring the life you've built together, even if life throws the unthinkable your way. And if you need help crafting that plan, don't hesitate to reach out. Because in retirement, failing to plan for the widow's penalty isn't just a missed opportunity. It's a ticking tax time bomb. Thanks for watching.